Welcome, everybody, to another episode of Multifamily University. My name is Anna Myers. I am so happy to be here with you today. And with me is Jay Scott, who has been with us before, delivered incredible information. And we were so happy to have Jay come back with us on the platform with a completely different subject, but equally nerdy and compelling, which I love. So before he gets into his thing, I want to let you know that, yes, this is being recorded, and yes, you will get a replay. I have to ask, Jay, will there be a deck, a PDF of the deck that will be included?
I am absolutely happy to send over the deck for anybody that wants it.
Great. So the PDF will be included with the replay that will be sent out. And in the meantime, as you're enjoying the presentation, feel free to type your questions into the Q&A. We will get to them at the end of the presentation and answer as many of them as we can. And with that, I'm going to hand over to Jay.
Awesome. Thanks, Anna. Thank you.
And I'm going to turn off my video just to not distract.
Perfect. I'm going to do the same thing so I don't have to look at myself. Okay. Well, thank you, everybody, for joining. I really appreciate this. And as Anna mentioned, I have presented here before, and what a fantastic group of people. I appreciate everybody coming out, and I'm thrilled to be back. I tend to speak quickly, and I tend to pack a lot of information into my presentations. So tonight, if I go quickly, I know that there's going to be a replay made available. I also know that that I will make the slides available, and I'm also going to be available for questions both after this presentation, and you're always welcome to reach out to me if you have additional questions that I don't answer here. Tonight's discussion topic is multifamily return metrics, the good, the bad, the ugly. Actually, not so much the ugly, more the good, the bad, the interesting, but that just didn't flow as well. And so I think for some of you, what I'm going to talk about tonight, I have a feeling you might say some of this is old hat, is stuff you already know. But I promise you, not I promise, but I suspect that that there's going to be some new stuff, even for you folks that have invested in multifamily before, even for those who have actively run multifamily. I have a feeling you're going to get some interesting nuggets out of this, at least hopefully. So let's jump right in. So about me, my name is Jay Scott. I'm a partner at Bar Down Investments. We buy multifamily, mostly in Texas, but also in Ohio and some smaller stuff in other parts of the Southeast. We syndicate. We have about $110 million in investments right now. I'm the author of 5 books: the book on flipping houses, estimating rehab costs, negotiating recession-proof real estate investing, and my newest, Real Estate by the Numbers. I currently own about 800 single-family and multifamily units, and I've done about 150 million in transactions. So that's the basics of me. I do want to mention that I do have a new book out, my 5th book. It came out on October 13th on BiggerPickets. It'll be out November 15th on Amazon and in bookstores. And what I'm talking about tonight is basically about 70 out of the 420 pages of that book. So it's a pretty thick book, pretty dense, but this will deal with one section of that book. And if you're interested in learning more, go to numbersbook.com. Okay, let's jump into the presentation. So for anybody that has purchased multifamily real estate, syndicated multifamily real estate, or been a passive investor in multifamily real estate deals, this probably doesn't look too not familiar. This probably looks familiar. This is the basic information you're going to give if you're a multifamily syndicator to your passive investors. This is the basic information you're going to get if you're a passive investor. So to go over this really, really quickly, at the top, typically we're going to talk about whether it's a 506B or C offering, which is informative to know what the SEC rules are around the offering. The hold period is how long we typically plan to hold the deal. Member manager split, we'll talk about that in the presentation. And then the next 5 numbers: equity multiple, preferred return, average cash on cash return, average annual return, internal rate of return. Those are all return metrics. Those are all basically the expectations you can get for a financial return on your investment into this particular deal. And then finally, we'll talk about, or not we'll talk about, but the minimum investment for this deal, this just happens to be a deal that we did many months ago, was about $100,000 or $100,000 with exception considered. this is what we're going to be focusing on tonight. So we're going to be focusing on these return metrics. Again, this is the expectation of if you were to make an investment into this deal, what you would get back financially. And so a lot of both active and passive investors are familiar with these terms, but I've talked to a lot of people who don't know what each of these means or how to think about these returns, what the benefits of these return values are, what the detriments or the drawbacks of each of these return values are. And then also, I'm going to talk a little bit about the how we as multifamily operators can sometimes manipulate, or I don't want to say manipulate in a bad way. Sometimes it's in a bad way. Normally it's in a good way. There are ways that we can play with these numbers so that we can give better returns or worse returns in certain areas, trade-offs in various areas in order to come up with a very creative deal structure. Now, sometimes it's a way that we can be nefarious and try to manipulate our investors, but generally it's just being creative in ways that we can provide more creative and interesting trade-offs to our investors. And I'll talk about that. And so I refer to that as kind of the good, the bad, the ugly. The good about the metrics, the bad about the metrics, and then something interesting that you may not know if you're not a seasoned syndicator. Okay. This is kind of that same presentation in the last slide. This is all of the return metrics, but this is something, and basically this was exactly for the deal that you saw on the last slide. This is what I gave to my investors when I did an overview of the deal. And this is a more detailed overview of the returns that investors could expect. This is an annual breakdown of returns. And so in this presentation, I'll kind of be using this as just an example project. This is a fairly standard deal that you'll see in the multifamily space these days. And so if you've looked at any deals recently, the numbers were probably not too dissimilar from this right here. Okay, so let's jump in. First one I want to talk about is equity multiple. This is a very simple metric that many of you may have heard of. But the purpose of equity multiple is to answer the question, how much will my investment multiply over the hold period? And again, very simple metric. This is an indication of how many times your investment is expected to multiply over the hold period. So for example, if you were to invest $100,000 into a deal where the equity multiple was a 2, you could expect that you would get back $200,000, your $100,000 initial principal investment plus $100,000 in profit. If the equity multiple were a 3, you could expect to get back a $300,000. Again, $100,000 as the original investment, $200,000 in profit. That's pretty simple. So let's look at the math behind equity multiple. So equity multiple is basically the ending value of the investment divided by the starting value of the investment. Again, very simple calculation. So here is our initial investment. We're going to assume that a passive investor were to invest $100,000 into this deal. That's the starting value. And then we're going to assume that their return on this deal is $95,400 and change. So the total amount that the investor would be getting back at the end of this deal or throughout the deal, maybe not just at the end, throughout the deal, the total amount that the investor would be getting back is $195,437. So that's the ending value, the initial investment plus the profit. Plug that into our formula. Equity multiple equals 195,000 and change divided by $100,000 equals 1.95. So basically, we're expected to just under double our initial investment in this deal. That's a 1.95 equity multiple. Pretty simple. I imagine a lot of you are familiar with that. Let's talk about the good, the bad, and the ugly for equity multiple. So the good thing about this particular return metric is that it's pretty concise and it provides a very quick, very easy indication to even the most unsophisticated of investor on what they can expect their investment to grow or how they can expect their investment to grow over whatever that hold period is. So that's the good thing. It's a very simple metric. Even unsophisticated investors can typically understand it. And a lot of investors actually ask for it. Now, the downside of equity multiple is that a lot of us as more sophisticated investors, we're used to seeing metrics that are more percentage based. And so it can be difficult for us to translate a multiple into a percentage, at least taking time into account. And so for more sophisticated investors, equity multiple basically doesn't give us a whole lot of information. Here's the ugly part of the equity multiple. So typically, we assume as operators that equity multiple is applied to a 5-year hold time. So we assume that a 2x or a 2 equity multiple is a doubling of your money in a 5-year time frame. A 3 equity multiple is a tripling of your money in a 5-year time frame. But here's the thing. There's no definition, there's no formal definition of equity multiple that says we're talking about a 5-year hold period. So there will be operators who will say you're getting a 2-year, a 2 equity multiple without saying a time frame. You don't know if that 2 equity multiple is in 2 years or 5 years or 10 years. And so it begs the question, is a 2 equity multiple better than a 3 equity multiple? Not necessarily if that 3 equity multiple is in 6 years, or I'm sorry, in 10 years, and the 2 equity multiple is in 5 years. You're going to do better on a 5-year investment that doubles your money than a 10-year investment that triples your money. So operators can use equity multiple to distort the view of the return of the deal for unsophisticated investors. So if you're a passive investor in a syndication and you see an equity multiple number, always ask the operator, is that based on a 5-year hold period? If not, what is the hold period that that's based on? So that way you can do an apples to apples comparison of equity multiple or return multiple for different deals that you look at. Okay, that's equity multiple. Now let's talk about average cash on cash return. So this number right here. Average cash on cash return aims to answer this question. What percentage of my investment will this deal return per year on average from property operations? I'm not talking about what your deal is going to return overall. I'm talking about what your deal is going to return from property operations. So let's talk about what that means. Let's go back to our little return spreadsheet here. This is what the passive investors can expect in terms of returns. This line right here is your member cash flow. This is your annual cash flow from operations, meaning on an annual basis, your property is going to make a certain amount of income from rent, from pet fees, from parking, from laundry, whatever else you might be charging in terms of fees to your tenants, minus whatever expenses you're going to have. So that could be property taxes, that could be insurance, that could be maintenance costs, property management costs. It's also going to subtract out your capital expenses. It's also going to subtract out your mortgage payments. Basically, this is the money that's left over at the end of every year that's available for you and your investors to basically take a distribution. This is only based on the operations of the deal. This doesn't factor in any money that's coming from what we call equity events. An equity event is something like a sale or a refinance where we get a big pot of cash by selling the property or refinancing the property, and maybe the investors are going to get a big pot of cash back. That's accounted for in this line right here. So in this case, our expectation is that we're going to sell the property in year 5, and investors are going to get this big pot of cash, this $60,000 in year 5. That's an equity event. And so when we look at the returns from a deal, in some cases, we're talking about overall returns, but in other cases, we're only talking about annual cash flow. In other cases, we're only talking about equity events. So it's really important to know whenever we're talking about a return metric, is it related to annual cash flow or operations, or is it related to these big equity events, or is it related to the overall returns from the deal? So going back to and so this would be the addition of both of those. This would be our annual operations distributions and our distributions from equity events. That would be the total return on the investment. So going back to our cash on cash return, I mentioned that cash on cash return is only related to operations. Basically, it's only related to the annual distribution or the annual cash flow that's generated through the income and expenses on the property. So to figure out the average annual cash on cash return, we need to start with what we call cash on cash return. And cash on cash return is in any given year. So cash on cash return is calculated based on a single given year. It's the annual cash flow generated. So the annual amount of cash flow available for distribution to the operators and the investors at the end of the year, divided by the initial investment made into the deal. So let's take a look here. So again, our annual cash flow in year 1, $6,660. In other words, investors can expect to get back about $6,660 for every $100,000 that they invest into this deal. So to determine our annual cash flow for year one, simple formula, cash flow divided by initial investment, in this case, $6,660 divided by your $100,000 investment. In year one, investors are getting a 6.66% cash on cash return. We can do the same thing for year two. In year two, investors are getting a 6.26% cash on cash return. We can do it for year three, where we go up to about 8%, 6.6% in year four, 6.9%, close to 7% in year five. Now, again, this doesn't count the income generated from the equity event in year five, that sale in year five. This is only the income from operations. So we've now figured out what our cash flow percentage is, our cash on cash return in each of the 5 years of the hold period. We can now use that information to get our average cash on cash return. Shouldn't be a surprise, but an average is basically the summing of the individuals divided by the total number. So in this case, we're summing up the cash on cash returns in each of the 5 years. We're dividing by 5, and that gives us our average cash on cash return over the entire hold period. In this case, those 5 cash on cash returns divided by 5 equals 6.9%. In an average year, we're going to receive about 6.9% return in cash flow from operations on our $100,000 investment, or whatever our investment is. Now, here's the interesting thing about cash on cash return. I don't like the word manipulating because it implies something nefarious. I probably should have chosen a better word there. This is actually pretty common in the multifamily syndication world. And as long as it's disclosed to investors, there's actually absolutely nothing wrong with it. We do this ourselves. But there's a way that we can manipulate that cash on cash return so that we can distort the actual return from operations. And so let's take a look at 2 investments, syndication A and syndication B. I'm going to keep this very simple. Let's assume syndication A, we raised $10 million for this syndication. Let's assume syndication A and B are essentially the exact same property. Maybe they are the same property, just we have 2 different investors or 2 different scenarios that we're running on the same property. Syndication A, we decide we're going to raise $10 million. That's going to be enough, along with our debt, to buy the property, to do our renovations, to cover any of our transaction costs, to get to the end of the project and to sell it. So we raise $10 million. We sell chunks of $100,000 investments. For each $100,000 that an investor invests, they get 1% of the deal. So 100,000 divided by 10 million, 1% of the deal. That makes sense. Syndication B says, I'm going to raise $11 million instead of $10 million. Now, why would syndication B decide to raise more money than syndication A? Here's the reason. When you raise more money, assuming you don't need the extra money, in which case here we don't need the extra money because we've already determined that for syndication A, we can get by with 10 million, and syndication B is essentially the same investment. When we raise extra money, we can use that extra cash to pay our investors cash flow. So what we're seeing on a lot of deals these days, and again, there's nothing wrong with this. We do this in our syndications. I know a lot of operators do this. The key is that it's disclosed to the investors. A lot of syndications these days are returning very little cash flow because with interest rates so high and deals being thin, we're seeing deals that just don't have a lot of cash at the end of the year, at the end of the first year, second year, third year. And so we're seeing naturally cash from operations coming back at maybe 3% in year one, 4% in year one, maybe if we're lucky, 5% in year one. But by raising an extra amount, we can take some of the extra amount that we raise and we can use that to bump up the cash on cash returns, the cash distributions in each of the years of the hold period. Now, there's good and bad about this. The good is that investors who are investing for cash flow are going to see higher cash flow than they would if the operator didn't raise extra money. The bad is that if we raise $11 million, every $100,000 investment is now only worth about 0.9% of the equity, not the full 1% of the equity. So we call this an overraise. And again, the good is that it allows us to bump up the cash on cash returns generally in the first, second, third year until we start to build some equity or we do a refinance. It allows us to build up our cash on cash returns, but investors are getting diluted. They're getting a smaller piece of the equity for every share that they're purchasing. So I would highly recommend, if you're investing in any syndications, good operators will disclose that they're doing an overraise legally. They're supposed to disclose that they're doing an overraise, but it's always good to ask operators, are you raising extra money to repay us and boost the cash on cash return? Are you doing an overraise? And as an operator, just know, and again, as long as you're disclosing this is fine, as an operator, know that this can be one trick in your arsenal to be able to bump up those cash on cash returns. Again, your investors are going to get diluted. You're going to see a little bit less money at the end of the day because you're paying more return on a higher amount of equity that you're raising. But this can be a good way to boost the cash on cash return or the cash distributions to your investors if they're naturally low from operations. Okay, so let's talk about the good, the bad, the ugly for cash on cash returns. The good provides an indication of how hard your cash is working to generate more cash. If anybody that watches Shark Tank has probably heard Mr. Wonderful talk about how he thinks of his money as little soldiers. He sends them out to capture other soldiers and bring them back to him. And that's really a good metaphor for cash on cash. Cash on cash return is a measure of how efficiently your money is going out, grabbing more money and bringing it back to you. So that's the good. The bad is that cash on cash, one, it's not necessarily representative of what you'll actually receive. Remember, this is an average. And if you were to receive, let's say, 0% distribution in year one and 10% distribution in year two, that's an average of 5% distribution. But you're not actually seeing 5% in either of those 2 years. You're seeing an average of 5% for the 2 years, but you're not seeing 5% in any given year. So the average isn't necessarily a representation of what you'll receive. And number two, this is only indicative of how strong the operational performance of the deal is. This isn't going to tell you how strong the equity of that may be and how much ultimately you're going to make from the overall investment. This only gives you an idea of how strong the operations are. And then the ugly, and again, I don't like the word ugly because that implies something bad, but it fit the phrase good, bad, and ugly. If not disclosed, this actually is ugly, but operators can use an overraise, raising extra money, as we talked about, to obfuscate the operational performance of the investment, to boost cash returns, and to dilute investors. Again, not a bad thing as long as it's disclosed. And full disclosure, I actually go out to my investors and I ask them before we do a deal, would you rather have a higher cash on cash return, or would you rather have no dilution and lower cash on cash return? And basically let my investors decide. Typically, my investors would prefer to see higher cash on cash returns, even with a little bit of dilution. And so we've actually done this overraise a couple times now because that's what our investors want, and it makes the deal a lot more beneficial for both sides. Next, let's talk about this number, preferred return, right here. So preferred return answers the question, what percentage of my investment will this deal return per year before the operators receive any profit? So preferred return is this interesting promise, and it's more than a promise, it's a contractual agreement, but it's an interesting promise that the operators make to their investors. They basically say the first X% of cash flow or cash on cash return that we make every year is going to come back to our investors before we take any. So it basically sets the minimum bar that investors are going to receive before the operators are to receive any cash flow from operations. So let's take a look at what that means. Here, so in this particular deal, we have a 6% preferred return. So basically, as operators, we're telling our investors that they're going to get a 6% preferred return, which means in year one, while there's a 6.6% or 6.66% cash on cash return, the first 6% is going to go directly to our investors. We don't touch that as operators. Investors get that 6% preferred return, and that remaining 0.66% preferred return is going to get divided up between the operator and the investor. Likewise, in year two, the first 6% goes to the investor, 0.26 goes to split up. In year three, 6% to the investor, and then almost 2% gets split up, likewise in years 4 and 5. But here's the interesting thing. What happens if in year one, we don't have a 6% return? Let's say our return in year one was only 5%, but we told or we promised or we contractually agreed with our investors that they were going to get 6%, but the deal only delivers 5%. Well, there's two ways that this can be handled. The most standard way is that any shortfall on that preferred return is going to roll over to the next year. So for example, if we promise the investor 6%, we only get 5% in year one, that extra 1% is going to roll over to year two. And now the investor is going to be contractually obligated to receive 7% before the operator receives everything. If they don't hit 7% in year two, the shortfall rolls over and rolls over and rolls over. That's the standard way to do things. Here's the ugly. Some unscrupulous, I shouldn't have said it that way. I apologize. It's not unscrupulous, but what some operators will do, and as long as they're disclosing it, it's okay, but make sure you're asking this question. Some operators will not roll over any shortfall in that preferred return. So they'll say if year one only returns 5%, but the preferred return is 6%, well, that 1% is now lost. Year two is going to start over at 6% again. If we don't hit that preferred return in year two, we're going to start over again in year three. Again, as long as it's disclosed, as long as it's in the contract, absolutely nothing wrong with that. So I shouldn't have said unscrupulous. I actually apologize. There's nothing wrong with that as long as it's completely disclosed. But it's important that you as passive investors ask this question. Does the preferred return, do any shortfalls in the preferred return get rolled over into the subsequent years? And generally the answer is going to be yes, but it's always worth asking and it's always worth reading the docs. So good, bad, and ugly on preferred return. The good is preferred return is a great way to align incentives between operators and investors. Operators don't earn any capital unless their investors hit some minimum target. The bad is there's no guarantee that in any given year, you're going to achieve that preferred return. Your expectations can be poorly set. So this is another thing that's worth mentioning. I'm going to go back real quick. If you were not to see this chart, if you were not to know that we were going to hit 6% minimum in every year, and the operator, let's say the operator were to tell us on this deal that the preferred return were 7%, and we didn't see this chart, or we didn't watch the investor presentation, we didn't read the docs, we just saw that the preferred return was 7%. Well, we'd probably be surprised in year one when we didn't actually get 7%. Now, nothing was being hidden from you. It was all here, but a lot of people hear 7% preferred return. They assume they're going to hit that minimum in every year. A lot of times that's not true, especially in the early years of a value add syndication. Cash flow is a little bit thinner, and a lot of times we aren't going to hit that preferred return in year one. So don't assume in every year, just because a preferred return is 6% or 7% or 8%, that you're actually going to receive that. So again, the bad is there's no guarantee that you're actually in any given year going to receive that preferred return. And if you don't know that, that can be an issue with expectations being poorly set. And then the ugly, and again, nothing wrong with this as long as it's fully disclosed. But operators don't always accrue preferred return. If there's a shortfall in preferred return, operators aren't legally required, as long as they disclose it, to accrue any shortfall into future years. And so when they don't, incentives are no longer aligned. If there's zero cash on cash return in year one, or there's zero cash flow in year one and nothing accrues, it's very possible that you're just going to lose out on your income from year one. Okay. I am going to now kick this back over to Anna because she has some good stuff to share with you guys. Anna, are you prepared? Yes, no, maybe? Okay. I don't know if
Sorry. I was muted. Oh. Excuse me. Sorry. I was muted for a sec. So I am going to share, and I'll be getting right into it. I just have to choose the right share, right? All right. Can you see my screen, Jay?
I can.
Awesome. Perfect. So I just want to take a few minutes to let everyone know about a project that we're super excited about, and it's a value add. So I'm so glad you're here learning about how to look at value adds. But before I talk about it, I want to talk about some of our last 4 exits, which are pretty spectacular. And you're going to see some of that average annualized return, which Jay is about to talk about. So yeah, the data has been crazy for the last 4 exits. And it's pretty much, 103% annualized per year. That's a real number achieved. And any of the 4 exits The lowest average was just a jaw-dropping 48.4%. Pretty high numbers, as you'll learn, for average annualized return, but that is not where the industry necessarily is now. But last year, I want you to know, we slowed down our buying because we were seeing things getting a little overheated. Our data told us the market was way overhot. And really, you make money when you buy, not when you make your money when you buy the property and not when you sell it. So you got to make sure you buy right. Now, last year, we only purchased one multifamily, just one. And many of our syndicator friends, they purchased 4 or 5. But if we can't find deals with impressive investment potential, like the ones we're seeing here, we just keep hunting or we put down our pencils effectively. Well, we waited very patiently for the market to cool down. And now the prices are dropping and buyers, we're in the driver's seat. So finally, we have excellent conditions to swoop in and pick up some fantastic returns. So what are we doing? Well, we've got a value add fund. So we're adding 3 to 4 properties to our recently announced Grow Value Add Multifamily Income Fund. We are using our proven data science strategy to target the best metros and neighborhoods in the country. So with US housing prices expected to fall 10%, even 15% in the most overvalued markets, home builders, they're slashing their plans to build new homes. And this is creating underproduction of single family homes coupled with existing very sharp housing shortages. It's like pouring gasoline on a fire. It's the fuel, honestly, for outsized multifamily profits in the future and very happy multifamily investors. So bottom line, we're buying because we're able to find fantastic deals, and supply and demand, they're completely out of whack. So let's look at how we are cherry picking opportunities in the Grow Fund. So on the screen, we've highlighted some of the states where we're actively looking for properties: Texas, Arizona, Utah, Florida, Georgia, North Carolina, Tennessee. Now, we've already purchased a fantastic value add property in Sandy Springs, which is a terrific market just outside Atlanta. And we're continuing to look for outstanding deals, both Class A, Class B multifamily properties that have true value add potential. And we'll pick up these juicy assets at a discount because that's what's happening these days. We'll implement our proven value add strategy to improve the property and raise rents. We use data also to asset manage like monsters. And this increases the value of the property, and that's what gets the investors those returns. Now, it's important to note that we are buying cash flowing properties that have significant depreciation tax benefits. That is really key. So you got your metrics and you've got tax depreciation, which I don't think we're talking about tonight, Jay, but that is a big part of what investors get out of investing in multifamily. So here we go. Value Add Fund will have 3 to 4 properties that fit our highly curated requirements, just like the first one, Monarch Villas. So cash flowing properties. The Value Add Fund, this is Monarch Villas, 130 unit property built in 1969. Sandy Springs near Atlanta Metro. Honestly, we're blown away by the data science numbers in this small city. Truly off the charts. And no wonder Sandy Springs is located in Atlanta. And Atlanta has a massive boom, very low unemployment rates, but it still has that small town mid-density feel. And many people are really craving that post-COVID. So people who work in or around Atlanta or from home, they love Sandy Springs. It is an affluent, underlying affluent suburb located next to the Chattahoochee River, which is a little bit of a mouthful. It's got lots of jobs. And in fact, it was the most Fortune 500 company per capita in the entire country, which is kind of crazy that that's happening in little Sandy Springs. It's got lots of rivers, riverfront shoreline. It's got the #1 hospital density in the entire Atlanta. And you know, when a recession is coming, healthcare jobs, those are very stable. So we're really excited about that. So our value add business plan for Monarch Villas, property's in terrific shape, already has great bones, 62 classic units, just waiting to be primed. So take a detailed look at the left. That is an original unrenovated unit. Would you like to live there? No. Now look at the right. This is what happens when we complete the renovated unit. You know, we put in the full package, the backsplash, the sink, the countertops, the floors, change out the appliances. And with this type of change, that's where the value add magic happens. So spending 10 grand on an apartment makes a staggering 43% estimated return on cost. And that sets up our investors for a really great return. All right, so the Grow Income Fund provides excellent tax benefits for investors. We're expecting Monarch Villas depreciation and similar fund projects to come in around $60K for every $100K investor. And that is, of course, an estimate because we don't know the exact amount until we run a cost segregation study, which we definitely will. But we are all primed and ready as this is the last year, if you didn't know it, for 100% bonus depreciation. So here we go. Remember, we're talking about achieved returns on our last project. Remember, 48% annualized was the lowest. 103% was the highest. Well, let me remind you, all of those projects were conservatively underwritten, and so is the Grow Income Fund. So this is what we're projecting. Again, it's a fund. Simple returns of 17 to 21% IRR, 13 to 18%. Oh, sorry. Simple as 17 to 21%, IRR 13 to 18%, cash on cash 5 to 7%. Close to what Jay was just showing you. Again, these are conservative projections. We, of course, hope to beat the pants off of those. So for those of you that are interested, you can go over to growcapitalist.com/growfund, GROFUND, to get access to the investor kit. You can also join a Q&A call with Andrew, our investor relations manager, and you can get the link on that page. And there we go, growfund-group-call to get you some of that bonus depreciation before it runs out. So there you go. Back to Jay.
Awesome. And let me point out, the example I'm using is a deal that is about 7 months old. We're certainly starting to see returns thinner than what I'm presenting here. And what you just showed there, all those look really great. And I'll point out, I'm not familiar with those specific properties, but I lived in Atlanta, not too far from Sandy Springs for about 5 years. And I absolutely love that area. That area.
Everybody does.
Everybody does.
Everybody loves Sandy Springs. Anyone that knows Sandy Springs, they're like, that is a fantastic area. Absolutely. The shopping, I mean, it's just a fantastic location. So yeah, we're super happy to find it. We think it's going to be a great foundation for the Grow Fund. Yeah,
that looks like a fantastic portfolio. Okay. Getting back, let's talk about average annual returns. And so Anna was talking about average annual returns. So again, this is a very standard metric that we talk about. Average annual return answers this question. What percentage of my investment will the deal return per year from the investment overall? Now, we talked earlier about average cash on cash return, and we talked about how that's just the annual return, the average annual return that we could expect from cash flow, from operations. The average annual return is going to take into account not just operations, but also those equity events I was talking about, whether there's a refinance or a sale of the property. It's going to take into account any profits, any revenue that's generated from that equity event as well. So the formula for average annual return is basically the sum of all of the annual returns, not just the returns from cash flow, divided by the number of years held. So in this case, that's these numbers right here. So year number one is basically the same return as we saw from cash flow, because that's all we got in year one. We got cash flow from operations. Year two, same. All we were getting is that cash flow from operations that we talked about earlier. Same for year three and year four. But in year five, not only do we get the cash flow from operations, but we have a sale in year five. And that sale in year five is going to net an investor who has put in $100,000, about $61,000 in additional income, an additional profit from the sale. So this is the total return in each of the 5 years. We can easily turn these into percentages, just dividing by 100,000. And then if we add up the percentages for each year, so again, 6.6% in year one, same as our cash on cash return, same for year 2, 3, and 4. And then in year 5, our return is 67.9%. Total return in year 5, add those up, 95.44% is the total return on this deal, that number right there. And we divide it by 5-year hold period. On average, we're receiving about 19.09% per year. Now, one of the issues with average annual return, just like with cash on cash return, is that because this is an average, you're unlikely or you're not necessarily going to see that exact return or anywhere near that exact return in any given year. And we see that here. In years 1 through 4, our return is less than 8%. In year 5, it's over 65%. And yet the average is around 20, but we're never seeing 20 in any given year. So that's one of the limitations of AAR. It's a good indication of what we can expect on average over the total hold period of the property, but it's not necessarily going to give us an indication of what we can expect in terms of cash flow or distribution or return in any given year. So for investors who actually rely on getting money on an annual basis, and we'll talk a little bit about this in a few minutes, this could obfuscate exactly how much money is being received in any given year. Let's talk about another issue, another limitation of average annual return. And this is always an interesting little exercise. Let's say I have 3 deals. And on all 3 deals, I invest $100,000 into the deal. On the first deal, I hold it for 3 years. And basically, I receive a 10% return in year 1, a 10% return in year 2, a 10% return in year 3. We've already learned about AAR and how we calculate it. It's basically add up the 10%, divide by 3. So the average annual return on this particular investment is 10%. If we were to actually stick this into a calculator and compound our $100,000 by 10% a year, what we see is our ending balance is $133,100. Now let's take a look at investment number 2. Again, we're investing the same $100,000, but this time, instead of getting 10% per year, we're getting 20% in year 1, 10% in year 2, and 0% in year 3. Stick this in our AAR formula. We add 20 plus 10 plus 0, divide by 3. And once again, our average annual return is 10%. But we stick this into a compound interest calculator, and we see that we're actually only receiving $132,000 because we're getting the bulk of the money back in year 1. We have less compounding on the back end. Investment number 3, we do the same thing. We invest $100,000. This time we get 30% in year 1, 0 in year 2, and year 3. As you probably suspect, the average annual return is again 10%. And this time, the total return on the back end is only $130,000. So in all 3 examples, we're investing the same amount of money. We have the exact same average annual return, but you can see that the ending balance is a good bit different between the 3 deals. Now, this is a very simple example with deals that have longer compounding periods, with deals that have more disparate returns. These numbers can vary even more widely. And so one of the limitations of average annual return is it doesn't necessarily give you an indication, and it can be impossible without more information for you to determine how much you're actually going to end up with at the end of the deal just based on your average annual return, even though it seems like it should be pretty obvious. So let's talk about average annual return. The good, it provides an easy to understand expectation for your average return on an annual basis. The bad is, depending on the smoothness of the returns, using AAR to estimate your actual profit, it can be difficult. It can be impossible if you don't have more information. And for the same reason, looking at AAR and using that to try to extrapolate how much you're going to make on a deal, you can end up underestimating or overestimating a good bit on your actual returns. Okay. And that takes us to my favorite one, internal rate of return. This is one that I think confuses a whole lot of people. And I could probably do an entire 2-hour presentation on this and confuse you even more. But I'm going to do my best to try and explain what internal rate of return is in plain English. So that's this number right here, this 15 to 17% in this case. And internal rate of return strives to answer this question. What is the compounded return on our overall investment? And let's talk about what that means. So before I jump into what IRR is and how it works, let's do just a quick refresher on how simple and compound interest work. Let's say I invest $100, and let's say I invest it for 5 years at a simple interest return of 10% per year, which basically means I am getting a 10% per year return on my investment, but the money I'm getting, I'm either taking out of the investment or it sits in there. It doesn't actually work for me. So after year 1, my $100, I get a 10% return. So I now have $110. The end of year 2, I generate another 10% return on my $100, and now I have a total of $120. As you can probably guess, year 3, I end up with $130, $140, and after year 5, I've generated $10 per year in interest, 10% per interest per year for 5 years, and I have a total of $150. Great, that's simple interest. How about compound interest? How about compounding our money? What compounding means is that we take our money, we invest it, we receive a percentage return, but instead of taking that money out of the deal or letting the money sit in the deal and not work for us, we actually reinvest that money into the deal so that in the next compounding period, in the next growth period, our total investment, both what we originally invested plus the money that has been returned to us, gets compounded for the next period. And then any return on that period gets compounded for the next period and so forth. So let's take a look. So let's say we start with $100 and again, 5 years, same rate of 10%. In this case, we get after 1 year, the same 10% return. So at the end of year one, we have $110. Now, instead of letting the $10 sit there or taking it out of the deal, we're going to reinvest the $10 back in. So at the end of year one, we're now going to reinvest the entire $110 into the deal at an additional or the same 10% per year. At the end of year two, because we invested 110, we're getting $11 in interest in year two. So we now see that at the end of year two, we have 121 total. At the end of year two, we're going to reinvest that entire $121, and we're going to get about $12 in interest after year three. So now we have $133. We reinvest all that. We get about $14, $15 back, $13 back in year four. We reinvest that, and in year five, with the compounding, we end up with $161. In both of these scenarios, we invested $100, but by compounding the money every period, every year, we end up with a whole lot more at the end than we did in the scenario where we're just using simple interest. Hopefully that explained. And I don't think I need to talk about the power of compounding. Whenever you see a returns chart that kind of shows a hockey stick description of returns, typically that's based on compounding. The longer you have to compound your money, the faster and faster it accrues, and the more you get that hockey stick looking pattern in your returns where you're seeing exponential returns as opposed to just linear returns. Okay, so I think we can all understand at this point that in this particular example, to turn $100 into $161 in 5 years, we had to compound that money at 10% per year. To say that again, to turn $100 into $161 in 5 years, we need to compound on an annual basis at 10%. What that means is that the IRR for a deal that starts with a $100 investment and ends with $161 is 10%. IRR is just the compounding rate that you need to use to get from point A to point B. So if I were to have and I'll multiply by 1,000 just to make it more syndication-like. If I were to invest $100,000 into a deal, a syndication deal, on day one, and at the end of 5 years, I was to be handed back $161,000, the IRR, the internal rate of return on that deal would be 10%. And there's no easy way to calculate it. I can't give you a formula. I could, but it wouldn't help you. We typically calculate IRR using a spreadsheet or a financial model. But IRR is just a reflection of what it requires to compound, what the compounding rate is required to go from point A, in this case, $100, to point B, in this case, $161. Okay, hopefully that was a reasonable explanation. Now, unfortunately, it gets a little bit more complicated than that. In this example, we started with $100. Or here, let's do a different example. I apologize. In this example, we're going to start with $100, and we're going to turn that after 5 years into $500. So imagine an investment where you hand me $100, and in 5 years, I hand you back $500. That money is compounded every year. At what rate do we need to compound that $100 every year for it to turn into $500? Turns out that rate is 38%. So if we take $100 and we compound it at 38% a year, in 5 years, we're going to have $500. So a deal that starts with $100 and returns $500 at the end of 5 years is said to have an IRR of 38%. Okay, same as the example we did before, just using bigger numbers, 100 to 500 instead of 100 to 161. We have to compound at 38% rate to get from $100 to $500 in 5 years. Now, this is where internal rate of return can get messy. In this example, we've started with $100 and we ended up with $500 at the end of 5 years. What if we started with $100 and instead of getting $500 at the end of 5 years, we get $100 for each of those 5 years? Now, as you can see, we're not ending with any more profit from this particular deal. We started with 100, we're ending with 500. The only difference is that we're getting money back sooner in this version of the deal. We're getting $100 in year 1, $100 in year 2, et cetera, up through year 5. IRR assumes that if we get money back, what are we going to do with it? Are we going to go buy a car? Are we going to go spend it on dinner? No. IRR assumes that if we get money back sooner, we're going to reinvest it. And we're going to reinvest it in a deal that's equally as good as this particular deal. So the IRR in this case assumes that $100 that we get back at the end of year 1, we're going to reinvest into a deal just as good as this deal for the next 4 years. If we were to invest $100 in another deal just as good as this deal for the next 4 years, that $100 is going to turn into $1,488. IRR is also going to assume that we're going to take the money we get at the end of year 2, and we're going to reinvest that for 3 years because we have 3 years left on this investment. If we were to invest $100 for 3 years at the same return as we're getting on this investment, we would end up with $757. Year 3, we get another 100. IRR is going to assume that we're reinvesting that money at the same rate as we're receiving here, and we're doing it for another 2 years, which would yield us $386. And at the end of year 4, we have another $100. And IRR is going to assume that we reinvest that for the final one remaining year to turn into $196. At the end of year 5, we're getting our $100. We don't have any time left, so we can't actually reinvest that. So we get our $100. So IRR assumes that if we get money back sooner, we're going to reinvest it. In this case, we're taking that $100 and we're turning it into, as far as IRR is concerned, $2,921. IRR is going to assume that because we got money back sooner and we reinvested it, that at the end of the day, we're going to end up with $2,921. Now, this deal is only returning $500, the $500 that we talked about originally, $100 per year. IRR is assuming we're going to find some place to put that money and we can turn it into $2,921. Now, what is the compounding rate that we need to take $100 and turn it into $2,921? 96%. We would need to compound $100 at 96% for 5 years to turn it into $2,921. So let's recap those two scenarios. Scenario 1, we have $100. We turn it into $500 that we get back at the end of the period. Our IRR on that deal is 38%. Next, we look at another deal where we take $100 and we turn it into $500 again, but instead of getting it back at the end, we get it back $100 a year for 5 years. Because IRR assumes reinvestment, your IRR on this particular deal is going to be 96%. Now, here's my question. Can you necessarily take that $100 every year and reinvest it in just as good a deal the minute you get it back for the next 4 years, 3 years, 2 years, 1 year, and generate that 96%? Probably not. Most of us don't have the ability to take every penny we get the second we get it, reinvest it in just as good a deal for the full timeline of the project. So that 96% is actually a theoretical maximum that you could potentially get if you could reinvest every $100 the second you get it for that full time period. In reality, most of us can't do that. And in reality, if you don't reinvest that money at all, you're still getting the same $500 in both scenarios. Though in the second scenario, the person that's running the investment is going to tell you that you're getting a 96% IRR because that's what the calculation is going to come out to. Because again, IRR is assuming you're reinvesting and you're making more money by getting it back sooner. Hopefully I did a good job of explaining that. Let me show you how this can be used by multifamily operators to boost returns for their syndications. Let's imagine we have a deal where we invest $100,000 and at the end of 5 years, we get a profit of $50,000. So at the end of 5 years, we get our $100,000 back and we get our $50,000 in profit. If you stick this into an IRR calculator, basically $100,000 invested day 1, get back $50,000 in profit in year 5, you would see that your IRR on this deal is 8.44%. Now, we as good syndicators know that if we give money back sooner, we can boost the IRR. So what if we were to say, instead of giving back the $500 at the end of year 5, we were to give back the $500 in increments, just like we talked about in the last example, $10,000 per year for 5 years. Because the money's coming back sooner, your IRR is going to assume that you're reinvesting, and it's going to boost the compounding return rate. And in this case, if you stuck that into a calculator, a deal that gives back the same $50,000 but $10,000 a year is going to represent an IRR of 15.2%. Now, what if we're really good multifamily syndicators and we say, hey, we can do that even better. Instead of giving back $10,000 per year, instead, we're going to give back $2,500 per quarter for the 5 years. Again, same $50,000, just given back sooner and more frequently. Stick that into an IRR calculator, about 18%. And then finally, let's say we wanted to start giving back money monthly. Instead of doing $2,500 per quarter, we start to do $833 per month. Again, the same $50,000, but given back on a monthly basis more frequently and earlier than the other scenarios, our IRR jumps to 18.7%. In all 4 cases, we've invested $10,000. We've returned $50,000 in profit plus our $100,000. We've just returned it in different time periods. We've returned it more quickly and sooner in the bottom 3 scenarios than in the first scenario, and that boosts our IRR. So one thing to keep in mind is if you're comparing IRRs between 2 deals, where one deal is returning a quarterly distribution and another deal is returning a monthly distribution, and the IRRs are exactly the same, that's an indication that the quarterly deal is actually a little bit better, just because you're returning money not as quickly, but you have the same IRR. Now, I'm not saying there's anything wrong with this. A lot of us, we were doing quarterly distributions. We're now doing monthly distributions. We're the first to tell our investors that we're not doing it to boost IRR. We're doing it because our investors like monthly distributions. But it is one way that we as operators can obfuscate the returns if we're not honest with our investors. So keep in mind, when you get these returns back, your IRR is going to look different. Now, in each of these cases, let's take the quarterly and the monthly case. Quarterly, if money comes back quarterly, our IRR is about 18%. Monthly, it's about 18.7%. But realistically, if you get money back a few $100s or even $1,000 per quarter versus per month, are you really going to reinvest it any differently? At the end of the day, you're probably going to be left with the exact same amount of money at the end of the deal, because you're going to reinvest quarterly or monthly profits exactly the same. But the deal sponsor, the operator, can boost a higher IRR by delivering that money back on a monthly basis. Okay, so good, the bad, the ugly on internal rate of return. Turns out internal rate of return is literally the best tool to compare investments. If I were to compare a flip to a rental, or a syndication to a business investment, or if I'm buying a racehorse and a piece of art and I want to compare returns, as long as I can make assumptions about the cash flow, I can do a pretty good job of comparing the IRRs to know which one is a relatively better investment. But the bad thing is, the IRR is typically going to be a theoretical maximum return. If you hear that you're getting a 10% or a 20% or a 30% IRR, what that typically means is, in the absolute best case where you reinvest every penny, you're going to get a 10% or a 20% or a 30% IRR. Now, if you're looking at 2 deals and they're both 18% IRR, you're probably not getting 18% on either of them. So it doesn't mean that one of them is better than the other. You're probably getting lower on every deal that you see an 18% IRR. Again, it's a good way to compare deals, but don't ever assume that you're just going to get, or that you're actually going to get back the compounded return indicated by the IRR, because you're probably not a good enough investor to reinvest it as quickly as needed to get those returns. Finally, the ugly, like I mentioned, and again, I hate using the word ugly because a lot of us as operators do this. We return monthly versus quarterly, or quarterly versus annually. We're not doing it to try and manipulate our investors or trick our investors. But the reality is, by returning money sooner, we can change the IRR and we can make the IRR look higher by returning money sooner. So it's just a good thing as an operator to know that you have the ability to manipulate your IRR. Again, be honest with your investors. And as an investor, it's good to know because you can now ask questions and you can now run the analysis yourself to determine how much the IRR is attributed to when the money is coming back versus how much is coming back. And that is preferred return. And I didn't do a good job of creating a slide that summarized all of these. I apologize. But if you want to connect with me, if you have any questions, I'm happy to send the slides to anybody that's interested. You're welcome to scan that QR code or just go to www.connectwithjscott.com, and that'll link you out to my website and my social media and all of that. Okay.
Awesome. I am going to launch a poll for people to answer while we're getting to these questions. So again, please type your questions into the question or the Q&A box, not the chat box, and we will get to as many of these as we can. So you ready? Ready, Jay? Oh, somehow your mic got turned off. There, oops, mute on, mute off. There you go.
Oh, okay, let's see if I correct one. Oh, is that better?
That's better. That is perfect. Okay, let's start. So this person is asking, what metrics should we focus on, ROI or ROE?
So typically, I don't like to focus on ROI or ROE for multifamily or syndication or passive investments. ROE is a great way. Basically, the ROI is not a return metric that I like at all. The problem with ROI is that it doesn't take time into account. If I were to buy a deal, let's say I buy a house for $100,000 and I sell it for $200,000, I've made 100% return. I think we can all agree on that. Now, that ROI might be 100%, but it doesn't tell me if I made that ROI in a year or 5 years or 20 years. So there are better metrics than ROI. Average annual return is a good one. So let's say I made that 100% in 5 years. I can say that my average annual return is 20%. That's a bit more meaningful because it actually puts a time bound on the investment. ROE is a separate metric. A good use of ROE, and for those that don't know, ROE means return on equity. It's basically where you are, you're dividing whatever return you're making. Typically, it's on an annual basis, just like cash on cash return. But instead of dividing your cash flow into your initial investment, you're dividing your cash flow into the total amount of equity that you have in the deal. And the thought is that the more equity that you have in the deal, the less that your money is working for you. Basically, $5,000 return on a deal that has a $50,000 equity is not working as hard for you as $5,000 on a deal that has $10,000 in equity. That equity is working harder for you because you have a higher ROE. And ROE is a great metric to try and determine, is now a good time to be refinancing or selling a property? Typically, as ROE drops, we start to think, okay, how can we boost our ROE? Because we want our money working for us as efficiently as possible. And generally, the best way to boost your ROE, again, is to sell or to refinance. So ROE is a great metric to look at to determine, should I be refinancing or selling this property right now?
All right. When you do an overraise to return cash, isn't the cash taxed at regular income rate versus the greater cap gain that is taxed at a lower rate? Not raising the cash on cash is worse for the investor?
Oh, okay. So let me start with, I'm not an accountant and this is not tax or legal advice. Everybody's situation is going to be different. So in this case, you're assuming that taxed at regular rate is higher than a capital gains rate. For a lot of passive investors, capital gains rates, well, for everybody, capital gains rates are either 15 or 20%. But for a lot of passive investors, their marginal tax bracket is well above 20%. So if anything, they're actually going to be paying more if you do an overraise, because when you do the overraise, if that money is coming back to you in cash flow, you're typically going to be paying your marginal tax rate, as opposed to if that money is coming back to you in equity at the end of the deal, where you're going to be paying capital gains. So for a lot of passive investors, the overraise is going to hurt from a tax standpoint. That said, a lot of these investors, a lot of these investments, and Anna, you talked about this in the fund that you put out there, are generating a tremendous amount of tax benefits, depreciation and cost segregation. And so what we see for a lot of these deals is a lot of us can offset pretty much all of the income that we're getting from the syndication using the tax benefits. And at the end of the deal, we need to recapture that tax. We need to pay that back. But typically it's going to be at a fixed percent, which is a maximum of 25%. So at the end of the day, in reality, it's not really going to impact taxes at all for the most part, because what we're mostly paying for these deals is that depreciation recapture, which is going to be up to 25%. But if you were to ignore the depreciation, you were to ignore the tax benefits, it really depends on your tax situation. If your marginal tax rate is higher than 20%, then an overraise is going to be bad for you. If your marginal tax rate is under 20%, then you're going to like an overraise because you're going to get more money in cash flow paid at that lower rate.
I just wanted to add another word that I know for what you're calling an overraise is working capital.
Yes.
So I've never thought that it's a bad thing for a syndicator to raise extra working capital, because the first couple of years can be somewhat unstable and imbalanced. And so the working capital can smooth the cash flow, but can also provide more capital on hand in case there is some type of event. It actually, I think, reduces the risk for investors that they would have to add more capital in.
Yes.
And then typically when you end up not using that working capital about the 18-month mark when things are stabilized, then the excess working capital is returned to investors. So 100%. I see it as a protective method as well. And I think that investors should look at it that way, that it's not a bad thing or an ugly thing. It can be something that really is helping reduce the risk and then gets returned to investors, so that they don't have to put in extra capital. That's never a good call to have a capital call.
Absolutely, and I agree with you. Again, we do this as well. We do this in our deals, and I certainly, again, I need to think of a better title than the good, the bad, and the ugly, because again, there's nothing wrong with this. It's important that we recognize what's going on as passive investors, so we can ask the right questions. It's important to recognize how this works as operators, so we can structure our deals in ways that make the most sense for our investors. But no, there's nothing inherently bad about that. And again, I have polled my investors, and they routinely tell me they would much rather us do, and again, I call it an overraise, you can call it whatever you want, working capital. They would much rather us do an overraise to smooth out their cash flow and boost their cash flow in those first couple of years. And they're willing to put up with a little bit of dilution in order to get that. Because a lot of our investors, they like that cash flow. They like to rely on that cash flow, and they'd rather see smooth cash flow than really, really choppy cash flow.
Right. Okay, so here's a good question. Nowadays, we see that the senior debt is somewhere in the 60% range, and operators bring in preferred equity for 20% and then common equity for the remaining. Yeah. What are the advantages, disadvantages for bringing in preferred equity, basically another layer between senior debt and common equity?
So in my experience, it's not a whole lot more common. These days, yes, we're definitely seeing senior debt somewhere in the 55 to 65% range. If we're lucky, we can get our core debt at 70%. What I'm seeing a lot of these days is just raising more common equity, where we're seeing 30, 35, 40% common equity. Here's the interesting thing. When we talk about debt and equity, we have to realize that things change. And so for the last 10 years, interest rates have been so low that as operators, we've wanted to get as much debt as possible. If we could get 100% debt and not have to use any passive money, not have to raise money from any equity investors, we'd love to do that because debt's been so cheap. We can pay 4% a year or 5% a year interest, and not have to worry about that 14% IRR that I was talking about to investors, or the 6% cash flow or 6% preferred return or 8% preferred return. But here we are in 2022, interest rates have now spiked, And we're paying 7.5%, 8% interest on a lot of these loans. So debt is now really expensive. But here's the thing, my investors are still very happy. And I imagine your investors are still very happy with a 5 or 6 or 7% cash on cash return. And so if I had the choice between paying 8% to my lender or 5, 6, 7% to my investors, I'd rather pay that 5, 6, 7% to investors on an annual basis than pay 8% to my lender. Now, my investors are going to get a big pot of cash at the end, which is going to be take money from the deal, but we're all going to be happy because we're spending less in cash flow. We're spending less in expenses every year or every month, which is going to allow us to have less risk in the deal and allow us to operate the deal a lot more efficiently. So these days, the fact that we're starting to raise more equity isn't a bad thing. It's actually better for us from an operation standpoint because our monthly payment is actually cheaper. Instead of paying 8% to a lender, we're paying 6% to our investors. So we're starting to see more equity than we were in the past. In terms of preferred equity, and so what is preferred equity for those that don't know? It basically means that we talk about this capital stack. We talk about money comes in, we have debt, we have loans, and then at the top we have our passive investors, our equity, the people that share in the profit and the loss, our partners. In the middle, we have these two things called mezzanine debt and preferred equity, and they're like two things that kind of sit in the middle where the returns are higher than debt. Basically, you're paying these investors more than you'd pay a lender, less than you would pay for the passive investors at the top. But their risk is lower because they get paid right after the lender and before the passive investors. So it's basically a piece of capital kind of in the middle that gets a little bit higher return, but is also a little bit safer. And often it's provided by a fund or an institutional investor, maybe even a local bank. And so preferred equity is certainly becoming more common because you can get it cheaper than regular investors. But I'm still not seeing a whole lot of it these days. But we're definitely seeing more of a shift from debt to equity, and we're seeing a lot more equity in these deals than we were seeing even just 6 months ago.
Yep. What do you foresee happening over the next 2 to 3 years in multifamily?
The hard questions.
Yes, I chose to put you in the hot seat.
Yeah, I'm bullish on multifamily. I got into multifamily back in 2018 because I believed that we were getting close to a recession. I thought we were going to see a recession in 2020, 2021. I guess in some ways you could say I was right, but I was very much not right about, nobody was right about COVID. And so I asked myself back in 2017, 2018, what asset class do I want to be in if we're heading towards a recession? And multifamily was kind of my answer. I like multifamily for a few reasons. One, it's a great inflation hedge. So typically with multifamily, when we have high inflation, and typically it's surprising that we're seeing inflation at 8-9%. It's sad that we're seeing inflation at 8-9%. We don't normally see inflation that high, but at any time you're approaching a recession, typically the reason we have recessions is because inflation's going up and the Fed's hiking interest rates. So it's safe to say that if we were heading towards a recession, that we were going to see more inflation. And the nice thing about inflation for multifamily investors, as long as there's not too much of it, is that inflation tends to translate into higher market rents. It obviously also translates into higher expenses, but it typically hits market rents more than it hits expenses. You have a little bit of a delta there. You can increase your NOI and it brings values up. So during recessionary periods, certainly we see cap rates expand. We see cap rates go up, which is bad for values, but we see market rents go up, which is good for values. Now think 2 or 3 years down the road. 2 or 3 years down the road, interest rates start to come down after the recession's over. Cap rates start to come down after the recession's over. But what doesn't come down? Rents don't come down. Rents never come down. So going into a recession, you kind of have these competing forces. You have higher cap rates, which are bad, higher rent, which is good. And then 2 or 3 years down the road, the cap rates fix themselves and you still have the high rent. And so multifamily tends to be a great inflation hedge. We are underbuilt by several million units in this country for the last
over
decade.
3 million. Yeah.
Yep. I suspect that home ownership rate has spiked over the last few years to 66%. I suspect that's going to drop again in the near future. So there are going to be a lot more people that are going to be, we're basically at an all-time historic high for home ownership rate. And with the unaffordability, if that's a word, of single family homes these days, it's likely we're going to see a lot more renters. We have 1.7 million new households forming in this country every year. And a lot of them can't afford to buy a house. And so that's a very large number of people that are now going to be looking for rental housing. Even if a lot of them could buy a house, 1.7 million households, we're only building about 1.1 million units per year. So there's still a few 100,000 extra people that wouldn't be able to get into a house anyway because there's just not enough supply. So long story short, I think that multifamily is going to see some softening cap rates over the next couple of years, some softening values. I think it's going to be more resilient than pretty much any other asset class out there. It's not going to be completely immune to a recession, but I would rather have my money in multifamily than anywhere else. And then in 2 to 3 years, I have a feeling cap rates are going to drop again. We're still going to see market rents high, and I think values are going to soar.
We're with you. We're with you, Jay. 2024, here we come, right?
Yep.
It's got to get there.
Yep.
So this person is asking, can you list the suggested metrics by investment class that would be ideal for a successful investment?
I like for any commercial deals, and that basically is anything outside of single family. For any commercial deals, the metrics I went over tonight. So again, equity multiple to some degree, cash on cash return, average annual return, internal rate of return. Those are the metrics that are going to be applicable to basically any type of commercial real estate deal. Now, it doesn't necessarily mean you're going to be able to compare deals. If I tell you that you're going to get a 15% average annual return on self-storage and a 15% average annual return on multifamily, doesn't make those equal deals. In each asset class, you can expect returns to vary because risk is going to vary and other things are going to vary. But those are the same returns that I would apply pretty much to any real estate asset class, and actually the same returns I would apply to most investments in general. From a single family standpoint, same metrics I would apply in single family. Though I would put more emphasis on that cash on cash number, simply because with single family, unlike syndications where we typically hold for 3 to 5 years, single family we're typically holding for 5, 10, 15, 20 years. And so the cash flow from operations is a little bit more important and a little bit easier to predict than what that revenue from whatever equity event takes place 5 or 10 or 15 years down the road.
Yeah, good. I like that. Is IRR always more meaningful than AAR?
They answer different questions. This is the reason why we have those 4 main metrics that I talked about. I'll talk about preferred return separately. There's the reason we have those 4 main metrics is because they all answer different questions. And so it really boils down to what's the question you're trying to answer and how you're thinking about your investments. I like IRR as a way to compare 2 different investments. If I'm looking at 2 different investments and I consider the risk to be relatively similar, that's the other thing that we have to take into account. Anytime you see one deal that has a 10% return and another deal that has a 20% return, it's probably not that the 20% return is twice as good as the 10%. It's more likely that the 20% return deal is just riskier.
That's right.
Doesn't mean it's a bad deal. New construction is going to be riskier than buying a stabilized property. It doesn't mean new construction is bad. It just means that there's probably going to be some more inherent risk. So when it comes to comparing investments, I really like IRR. When it comes to determining, kind of forecasting out what my investment is going to do over the life of the investment that I've chosen already, or that I'm looking at one specific investment, I like AAR. A 14% IRR, again, isn't very meaningful to me because I realize that that's a theoretical maximum. I'm not actually going to be able to achieve that. So that number is just, it's nice to be able to compare. This one's 14, this one's 18. That gives me an idea of what might be a little bit better, what might be a little bit riskier. But it's not going to tell me what I'm really going to get from the deal because I'm not going to achieve that theoretical maximum anyway. AAR is actually going to give me an idea. If I invest 100,000 and it's a 20% AAR over 5 years, I'm probably going to double my money.
That's right. Some passive opportunities have a 70-30 split, while others have an 80-20 split.
Yep.
How much does the investor lose in a 70-30 split with all things equal? And what are the ways that an 80-20 opportunity makes up the difference in other ways?
Okay, so this is my take on this, and this is how I look at deals and my team looks at deals. Those numbers are relatively meaningless to me. So the way we look at deals is we will underwrite a deal, we'll look at how the returns kind of play out, and then we'll apply this split. We'll start at 70-30. And with a 70-30 split, we say, what is our return? What is our projected return to our investors? What's the equity multiple? What's the cash on cash? What's the AAR? What's the IRR? The same 4 metrics I just talked about in this presentation. We'll apply the 70-30 split and we'll say, does that get our investors where we need them to be? If it doesn't get our investors to where we need them to be, like if the returns are too low, we'll say, well, how about if we give an 80-20 split? We give them more. And that'll boost their return. Maybe 70-30 gives them a ridiculously high return that is just unreasonable for us to be giving. And so maybe we drop it to 60-40. We'll play with that split until we can get our investors to the number where we feel that that is a reasonable and respectable return for them and can attract them to the deal and give them everything they want out of the deal. And then once we find that split, we then look and see what's left over for us as the operator.
Right.
And we say, is that enough for us to do the deal? If what's left over for us as the operator is $2,000, we're probably going to say, oh, nope, we're not going to do this deal. If what's left over for us as the operator is $50 million, we're probably going to say, okay, let's up the split and give our investors more. But it's basically, I think of it kind of like a slider. And right. It's a way to kind of get to modulate the returns that our investors are getting and we're getting, and to kind of find that sweet spot so our investors are getting everything they should be getting, and we're also getting a fair deal as well.
All right. Let's see. Jay, I'm going to ask you, because we're just about at time here, to look at the questions and maybe pick 2 that you want to answer.
Okay, let's see.
Here's one that should be pretty easy for you while you're looking at the other ones. For cash on cash returns, is there an industry benchmark of what a good cash on cash return is today, I would say?
No, I don't ever like doing that because every deal is going to stand on its own. And some deals you might be trading off cash flow. So I might do a deal, again, I could do a new construction deal where the operator says, we need every penny. And you're not going to see any cash flow for 3 years, but at the end of the deal, you might make a 40% return. And so is that not enough cash flow? Well, no, we're trading cash flow for other things in the deal. And so I like to tell people, look at a deal holistically. Don't just look at any one metric. That's why I like the fact that we have multiple metrics, because there are going to be trade-offs. So what's industry standard? 4 to 7% is pretty industry standard. Maybe 5 to 7% is industry standard. But again, you might find an operator that offers you 8 or 9%, but you don't necessarily trust that they know how to do the deal. You might find an operator that offers you 3%, but the IRR or the ARR for the entire deal is great on the back end. Or maybe it's an operator that you know and love and trust, and you can pretty much be guaranteed to get the profit that they're projecting. You might be willing to give up some cash flow for that. And so there are other things that play into it. Don't ever look at any one metric, kind of look at the whole picture. But if I had to pick a number, I'd say 5 to 7% is pretty standard these days.
All right. So go for it. Pick a juicy one, Jay. I know some of them are kind of long.
Okay, so what happens in year 5 at a year 5 sale when all the accrued pref returns 6% or barely met in the first 5 years? Since the sponsor didn't get any part of the cash flow in the first 5 years, does the sponsor catch up for their 30% first, and then whatever's left over is distributed? Yes, so this is the way most operators do it. Keep in mind, legally, an operator can do anything they want as long as they disclose it to you. So make sure you read the documents. But what's standard is that if you don't get your full pref in any given year, it accrues to the next year. So if there's a pref offered of 6% and $0 are paid over the first 5 years, then in theory, not even in theory, in reality, 30% return on your initial investment is now promised before the operator gets a split of anything above that. So you as the investor should be getting that 30% return on your investment that accrued 6% for 5 years before the rest of it is split. And then, yes, anything above that is split at 70-30 or whatever the deal split is or whatever the waterfall is. But yes, that's exactly how pref works. And again, some of us, we will actually expect that we're not going to hit pref in year 1 or year 2 or year 3. And again, as long as the operator is disclosing what the expectations are, there's no right or wrong way to do things.
All right, one more.
Okay. At the end of year 5 sale, if the total earnings of the project is 6% after the sale, does that mean the sponsor doesn't get anything from cash flow and all the returns?
Oh. Isn't that one you just answered?
No, that was, same person, different spin on it. Okay, good point.
Okay, got it.
Let's see. Did I not have an ugly on AAR? No, there's no real ugly on AAR. There's just the limitation of AAR that 2 deals that you invest the same and have the exact same AAR could return different amounts at the end because AAR doesn't deal with real choppy returns very well.
I know they're really long, some of them.
Yeah, I'm a slow reader. Do preferred equity holders share in the capital event and depreciation? It's every deal is going to be structured differently. Typically, they will participate in the depreciation, and many preferred equity holders. So common for preferred equity might be these days you get a loan for your major debt, and you might be paying 7%. You get your investors who are going to get a deal very similar to what we just outlined in this presentation. And then the preferred equity investors might come in and they might get a 7% cash flow every year, almost guaranteed, more like debt than equity, and then get up to a 10% AAR on the back end or 11% AAR on the back end. So they have a safer investment. They're going to get paid before the rest of the investors, after the lender, before the rest of the investors. They're going to get their 7%, but then on the back end, they're going to max out at maybe 10% or 11% or 12%, whereas the investors who are in a little bit, they're in the last position, which means they get paid last. But if there's a lot of money left over, they could see returns of 20, 30, 50% if the deal outperforms. So preferred equity is a safer position, but typically has a fixed upside. But they generally do receive some of that upside at sale.
Yeah, depending on how the deal is structured. Right? And always read the PPM. Yeah.
And again, as my syndication attorney would say, literally we can do anything as operators as long as we disclose it. So always read the docs, because a lot of times we'll do things that are not standard, but we do them because they're good. And so don't ever think that there's a right or wrong way to do things. There's lots of ways to do things. Just make sure that everything is disclosed. And if you're investing, make sure you ask lots of questions so you understand what's being done, and make sure you're good with it.
All right. And with that, do you want to throw up your little barcode one more time?
Yes,
so people can take one last snap there.
One last snap. Go to www.connectwithjscott.com. And I am really excited about this. If I can take one more minute, So Dave Meyer,
Yeah.
the VP of Data and Analytics at BP, and I co-wrote this book. It's about 420 pages of small print, and it's basically everything you need to know to think like a successful investor. So the strategies, the concepts, the numbers, the formulas. We talk about capital stacks. We talk about deal analysis. We talk about all the metrics that we talked about here tonight. We talk about concepts like compounding and time value of money. And then we get into a really good discussion of things like discounted cash flow analysis and NPV and all these things that you think, I'll never understand that. But I think we explain it in a way that even the most math phobic people can really understand it. So the goal here was basically to write a book that would be everything to do with deal analysis and underwriting and metrics and concepts and strategies that successful investors use.
Awesome. I know where I am going after this. I'm going to that website, numbersbook.com. That is right up my alley.
Awesome. Well, thank you. And if anybody has any questions, my email, and I'm always happy to answer questions about this presentation, j@jscott.com. Don't hesitate to reach out. If you have any feedback on how I can make this presentation better, literally the first time I've given it, if that wasn't obvious. So always open to feedback.
No, it wasn't obvious. That was great. All right. Thanks, Jay. Have a wonderful evening.
Thanks.
I know
everybody.
It's late for you too.
All good.
All right. Bye-bye.
Bye-bye.
Thanks, everybody.